Yeah.
Whoops.
And it's funny because they did a deal with a big Japanese bank. You would think that would give them some ballast, or that, oh, okay, this is a
Well,
potential
I think
takeout.
they, first of all, they had a lot of exposure to that thing, but I think because they were the underwriter, plus they just tried to do a $6 billion refinancing recently. I think there's a little bit of worry about the fallout of it. You know what I mean?
Yeah, that they did the deal because
Like,
they
what
had
did you
to.
know? Exactly. Like that kind of thing. Oh, you're inside, Robert. It is getting to be the fall. It's even a little chilly here in LA. So,
Yeah, it's a
I'll
little chilly.
retweet it.
That's not the problem. I have a dog I'm dog sitting, and I have house cleaners here with cleaning materials around. I gotta not be away to see what happens. I have a hard stop at 10:30 because I gotta pick up a kid that I dropped off for a doctor.
Well,
Turned out to be, had nothing to do
can't
all
hear
week.
you.
Can't hear me? Am I on mute?
Now you,
No,
you were
I
on,
can hear you.
you were on mute a second ago.
Oh, I was okay. I haven't touched anything, so maybe I've been getting messages about bad internet connection. So.
You know, that's happened to a couple of people in random spots in the last couple of days. It's weird. I mean, it's probably nothing, but there's been a cluster of internet connection complaints in my life, in my little direct circle.
Yeah.
Totally anecdotal, but whatever.
Interesting.
It would make our business a lot harder to do without internet.
Yes.
Yeah, let's tweet. Let's retweet here. I think I already did. All right, so did I. So we can kind of get started. I don't think Robert retweets a lot.
Robert, did you retweet?
I did not.
Why not?
Get in the promotional game, buddy.
Because I don't have my glasses and I'm blind. I can barely
All right, fair enough. We'll let you off on that one.
All right, well, let's get started. Today is October 9th, 2025. This is Wall Street Beats. Robert Marcin, Ben Brey, David Maris, kind of the dream team. We won't say to the others that we are the dream team, but we really are. We know it. We're going to talk about stocks. We're going to talk about small caps. We're going to talk about gold. We're going to talk about other stuff. But I will talk about healthcare at the end here. But let's, Robert, since you have a hard stop at 10:30, let's get started here with you. What do you have today, and what do you want to talk about?
Well, I want to talk about two of the small caps I've mentioned in the past. One was a sell, and maybe I'm selling too early. You never know. But the fundamentals don't deserve, in my opinion, holding it much above these prices. And I've sold it here before and bought it back a lot cheaper. So I'm hopeful. And that's Arteris. AIP is the ticker. It's a semiconductor. It's whatever, $600-700 million market cap now. So it's not tiny and trades a decent amount of dollar volume. But it's that semiconductor system on chip IP company. And it's probably about 7 or 8 times revenues now. It's supposed to be growing 20 to 30%. Management hasn't hit that ever with on a double comp basis. So they've been disappointing. And my basis is in the 4s. And I sold the stock at 13.5, 14 a couple days ago when AMD announced their deal with OpenAI. And Arteris was up 20% that day, even though AMD is a modest customer for them. They're in the AMD ecosphere. And I guess people felt that, a vendor to AMD would benefit as well. So they bid that stock up a lot. So I still love the IP. I'm not a fan of management's strategy of offering their customers a 10x return. I think a 10x return devalues their product and places into question the integrity of the financial model on a long-term basis because they lose a shit ton of money. And they have 80% of revenue in R&D spending, so that you can't make any money when you're spending 70 or 80% of revenue in R&D, obviously, even with 90% gross margins, which they do have. But that causes them to lose money, and they dilute the hell out of shareholders, about over 10% a year in stock comp. So You hold this thing 4 years, you know, you're going to have 40 or 50% more stock outstanding. That's not an insignificant amount of dilution. So I've been trading this between 6 and 8 at the low end of the range and 13 to 15 at the high end of the range. I've probably done it now 3 times, and I'm 100% out of it. So if it goes back to 6, I don't want anybody complaining about what I'm doing with it at 6. I'll be buying it back at 6. That's my Arteris strategy.
Okay. And their symbol again, you said AI.
P. It even has
AI.
AI in the ticker. It's
Who knows? That's probably why it's done so well.
yes. And then my buy, you know, we had some good news on my battery company, Electrovaya. They pre-announced a beat and a raise. It had their first $20 million quarter. That's ELVA, which, as people know, I've been recommending from the mid threes down to 2, and I have a nice profit in that. And because I got hurt last year not doing the 20 by 100 rule, David, which you mentioned, of trimming some big positions. When they double, I scalped about 10 to 15%, depending upon the portfolio, with more than a 2x in that at 7 and change, close to 7.5, which was the high. I'm looking to buy that back in the high 5s to 6, but I still keep it 90% of my stock. But they had a great quarter after I sold the stock, and I'm very excited that the thesis seems to be playing out. When you get a beat and raise with 60% revenue growth, and the next quarter should be 60% revenue growth, and I think the rest of the next calendar 26 should be a minimum of 30 or 40, and if we get lucky, 50 to 60% organic revenue growth. So I'm just very excited for that stock to, in the long run, be a $15 to $20 stock. But you never know on these things. And I had 2 stocks that I round tripped last year that wasn't fun, doubled back to cost basis. So I did a little scalping here with the intention of trying to buy it back a couple dollars cheaper. So they're my 2 updates.
All right. Well, that's been a great one, and it sounds like it has a lot more to go. I mean, $20 from 7 is a pretty good return.
Yes. Well, that's 3 years out. Not 3 quarters out.
Yeah. Well. All righty. Well, good. That's a good update. Ben, we're going to talk a little bit about currency. I mentioned before in the pre-show that one of the things I had heard on the drive in were a couple commentators saying that palladium and some of these tertiary commodity metals were starting to run, and that's a sign that that gold has entered the speculative range, that when it's starting to pull other currencies. And they also mentioned that the current gold market value is about half of the S&P 500. I don't know what that means. I don't know is that good or bad. They did mention it's an all-time high, but you can tell that from gold being at an all-time high. I don't know what to make of the second point, but what do you make of the first point? Do you agree with that?
The first point being that it's overbought right now, basically.
Yeah, that gold, that when you see these other metals running, that's a sign that people are just the speculative part of the market has entered the market for metals.
Yeah, I mean, that's kind of how things work, right? Like you have a primary, like you have gold works, then gold miners work, and then silver and some of the tertiary, plays work. And that's the same thing in markets, right? Like the core works, and then you move out into some of the garbage we've seen working over the last couple months. And it's actually just as a teaching point, like it's an interesting thing to monitor. And I know people who do it systematically, but like, tertiary risk divided by like kind of core, and like it's like the amplification and the compression of risk in markets, and it can be very like the S&P or gold itself might not tell you as much as some of the like how the rest of the complex is trading. So is risk like amplifying or compressing can be seen by that. But like, look, the gold miners we've talked about a lot. Those are running off a really high gold oil ratio, near the all-time highs. The only time it was higher was during COVID, when we had like that really artificial negative or low teens price because of the unique nature of that event. But it's also at the not all time, but like I have a chart 40 years high versus copper as well. And so relative to the two major traded commodities of the world, it's at its 40 years high. Relative to the S&P, it's becoming more and more stretched. So yeah, I don't think, when I was talking about gold almost a year and a half, 2 years ago on here, there wasn't nearly as many people talking about gold. I feel like all I hear now is people talking about gold. And, the return chasers are in there. It's a momentum trade now. So, yeah, I offered a little word of caution on that on Twitter. As my pinned tweet is talking about gold, but it was at 1900 at the time. Now that we're at 4,000. I don't know. The chart. I'm not really good at like playing with charts that are vertical. That's not really where I excel as a trader or investor. So I don't really have much for you other than I wouldn't be buying gold here. And I'm not saying you have to sell gold, but I would not be buying gold.
And what would you have to see to be like, hey, I'm on the other side of that. I'm selling gold.
You'd want to see central banks stop buying, basically. So, and that's takes a little while. That's low frequency data. But like if you were to start seeing central bank buying stall out, or if interest rates ripped higher, right? Like if real rates went to 4 or 5%, gold would get hammered. But so would all of risk, basically. And they're not going to do that. So, I'm not in the least bit worried about that scenario, but that would be the two things that, because most of the gold run, remember, like I showed how there was a divorce. Gold historically had traded with real rates and it had traded with the inventories of gold in the vault for the GLD ETF. And basically after the Russian event where America and Europe kind of seized Russia's 300 billion of treasuries, that was really what got the gold bull kicked off. There was a general worry by the rest of the world of like, hey, we need to diversify because these guys might just take our treasuries back. Which is, I would argue, is the stupidest move that we've made. Like, being pirates never is a good strategy. And although I guess if you're trying to get gold, it's a good strategy, but that's a different conversation. But the thing is that I think China has been the major buyer. India is always a buyer, but Chinese have been running a huge trade surplus, and they have to do something with that, right? And so they're reticent to continue to buy incremental treasuries. Now they're not selling treasuries, but they're just not buying incremental what they could be. And so there's a diversification going on. And I think that's been the primary driver. But now we're in the now the West is into it. Europe, like everybody, it's just got its own mind now. I mean, I think it's up like 55% year to date. Like, like what are we talking about? It's absolutely destroyed stocks. Then, and I might say stocks, I mean the indices. But yeah, it's crushed stocks on a 25-year basis, a 20-year basis. Usually, I have a chart. Maybe I'll make a report on this and update it. But like what I like to do is look at gold relative to M2, relative to oil, relative to copper, and relative to the S&P. And just a reminder that like over time, 1 dividend per share of the S&P kind of corresponds to 1 gram of gold. And there's oscillations. And when there's divergences, it's often a time to say, hey, it's time to buy paper, it's time to buy gold. With like the best two examples being 1981, 82, it was time to buy stocks. Gold was wildly overvalued and then went into a 20-year bear market. And then, in 2002, gold began its, 20-some year ascent that it's had after being on the penalty box for 20 years. And stocks, in the end of 90s and early 2000s were wildly expensive. So, I would pump
I have a comment for you. Gold in leading up to the great financial, gold did pretty well too, while stocks were starting to bad as a place to hide. And then this is a tweet from Ken Fisher, said the GLD dropped 77%, peaked off in from 08 to 09. Gold didn't act much like a safe place to hide in the great financial crisis. Is there any chance that it does the same thing if this whole thing blows up, or do you think it's different this time?
I don't remember a 77% drop. I feel well. So it traded really well, and then there was a big deleveraging, right?
Right.
At some point along the way, and so
Yeah.
yeah, like even this spring, which was a minor deleveraging, you could go back and look at it, and like that was the last thing to get sold in whatever March or whatever. So let's see, yeah, it went 175, yeah, to 100. So yeah, it had a no, but that was not true actually. That was after 2011 it did that. Like though during the GFC itself, it went from 95 into the height of it was like 70. So yeah, there was some, but stocks were down 50, right? And so
Right.
I still think it relatively outperformed stocks. And I did a report on which is should be on the Wall Street Beats website comparing gold during downturns to the Nasdaq and the S&P, and then obviously Bitcoin, because there's the meme that Bitcoin is digital gold and all that, and I just kind of show that that's not true, because during downturns, Bitcoin gets hit pretty hard, just like normal risk, actually harder, because it's just very tied to liquidity. But yeah, I still think it's better than stocks in a downturn, but you're not like it's not a bond, right? A bond, you're going to do well in a deleveraging type environment. And
Right.
speaking of that, let's talk about that a little bit. So this First Brands thing is continuing to gather steam here. And for those who don't know, First Brands was a auto parts manufacturer and kind of a collection of a lot of junky, like older auto
Brand.
part, brands. Yeah, exactly. And we're now up to estimates of a $50 billion loss. It could go down as one of the great frauds of our largest frauds in American history. And Jeffries is kind of the lead underwriter of it, and they own a bunch of it, and their stock's down. Oh, there's the dog.
There's my dog.
Uh,
Oh gosh, you mentioned Jeffrey's stock and
dog just comes
and
out.
dogs.
He's like he's like my people,
What a dog
my
that stock.
people. But yeah, I mean, look, since it kind of came to fruition in let's say, yeah, I think it was like the 10th of or 12th of September, Jeffrey's stock's gone from 72 to 54 this morning, so it's gotten hit pretty good. It was down 7 or 8% yesterday, but it's also the BDCs since then the BDC stocks have gotten drilled. The KKRs, Apollos, Blackstones, private credit shops have gotten hit. I mean, those term loans, which I don't know if how many of our listeners ever have dealt in the term loan business, but bank debt doesn't really trade. Like it's the bank debt's at one of them's at 5 cents. I was looking yesterday bid. The other one's at 14 cents. So yeah, it's very rare. So that's a huge collateral destruction. And so there's 507 CLOs, collateralized loan obligations, that own that. Like this is a big like hit. And then we also had Tricolor, which was a lender to immigrants and underbanked people, go bankrupt last month too. So we had two credit events in the bank loan business, and it could be the canary in the coal mine. And we're starting to see credit spreads in general start to go.
Is
What is
this
that?
is this a big enough market to start light the fuse or not? It doesn't seem to be. Like when in the great financial crisis, when we had that deleveraging, right? It was obviously the subprime mortgages that kicked everything off, and you could have said, "See, the canary in the coal mine was this first fund that shut down because it
Sure,
got wiped."
sure. So
Bear.
I'll give
Is
you
this
the
big
exact
enough?
example.
Yeah. We need
Yeah,
some perspective. Could this do that?
So in 2007, in March of 2007, we had Countrywide go out, if you guys remember, and people are like, and there was a couple sovereign wealth funds that had to put infusions into banks before that, even as early as Q4 06. But then
Right.
what happened after Countrywide, if you guys remember, in June of 07, we had those two Bear Stearns credit funds go down, and then
Right.
somebody had to buy those out, and they got smoked. And then that led to, in August, we had all the quant funds blow up because the funding markets got smoked. and then things just kind of progress from there, right? And I also would like to remind people that
That was
the
a huge
actual
that was a huge dollar value that was underwritten very poorly. Is this as
well,
big as that?
it's not as no, it's the subprime mortgages. The total losses from just the defaults was only 200 to 300 billion.
Right.
Okay, it's the leverage and the collateralized leverage system where, okay, that collateral's gone. Now we got to suck in other collateral, and when you have a lot of leverage, then basically it creates a domino effect. The difference maybe now is that I think a lot of the bad credit is in private credit, and that's tier 3 assets, and it's not mark to market, and often what happens when you have deleveraging is it's the mark to market that really like causes, oh well, now I'm being marked here, I'm hitting my leverage ratios, now I got to get out of that, or I got to start buying up volatility to hedge myself, or credit default swaps, and then that is the true price of money. True price of money goes up, assets go down, and it kind of feeds on itself. So I don't know, like, because this is all new, this private credit thing. We don't know exactly, how this will play out. But I know there's minimal transparency, and there's rising bankruptcies for a while now, and now we're starting to see some in the bank loan market. Even go back to the TMT boom. Remember, there was like, oh, here was a fraud, and then all of a sudden there was another fraud, and there was WorldCom, and what was that guy who had the $4 million party? What was that guy's name? Kozlowski. You guys remember Kozlowski?
Kozlowski from Tyco, yeah.
Kozlowski, yeah. And then obviously Enron, and it's that Warren Buffett quote is, you can see who's swimming naked when the water goes out. And so, right now it doesn't feel like liquidity seems fine. I mean, like, stocks are generally high, but you're starting to see this now. Imagine if liquidity starts to dry up, and then what happens is the bad players basically get brought out. And this First Brands, these guys are doing exactly what Lehman did. They were selling their inventory at a discount at the end of the quarter with a guarantee to buy it back at a 3 to 5% premium, like to what they sold it for, to hide the leverage and show different numbers. So,
So, well, but to give you a sense, though, Robert, this Jefferies came out and said they have about a $750 million exposure to this, at like an $11-12 billion market cap. So now what's interesting, and tell me, Ben, what do you think? The deal that they just did with Sumitomo was, interestingly, Sumitomo bought more stock, and they bought, if I see this right, $900 million, which is surprisingly close to the $750 million of the exposure. So
Right,
do you
right.
think, yeah, and this
Well,
deal was just announced in September. So is it
Right
possible
before they
that they saw this coming and they said, hey, listen, you own a piece of us. Let me disclose this to you. We're going to need to shore up a little bit. Is that what you
Right.
think happened?
maybe because this is held in something called Point Bonita, which is their fund. And by the way, it's 25% of their fund or 23% of their fund, which is incredible. So, the thing about these
Bonita,
CLOs,
by the way, Bonita in Spanish means massive loss.
pretty. No, he's pretty.
Pretty good glove.
Pretty loss. A pretty loss. Pretty big loss. um, but I don't know. That would be speculation on my point. But yeah, it is. It is interesting. But I will say this: these deals we keep seeing of Nvidia putting in cash, of maybe the Masa's son or Sumitomo. It reminds me a lot of like, oh, we're shoring these guys up. We got to keep this thing going. Like, we'll do some capital infusions to keep the game going. Whether it's in this case, like, hey, keep buying GPUs. Or hey, there's a credit loss. And one last thing on this, I shorted Carvana last week at 389, and when you look at the First Brands and you look then at the tricolor, and you start looking around at the auto space, and again, I bring up the I figured out that the auto space was bad because my Goodyear tire that I was long, that quarter was so bad like that conference call was one of the worst I've been on, and they're doing everything within their control, right? So I don't, I feel bad for them, but like the auto space is not a good space to be in right now, and I think it's as close to uninvestable as I've seen, and I usually like uninvestable, but this is in my mind right now uninvestable, and like we'll see what happens, but we're starting to see frauds. We're seeing BYD's having bad numbers and they're best in class. Tesla's earnings estimates have just been down and to the right, and I don't know why the stock's where it is, but like Goodyear's telling you this. I don't know. Yeah, the auto space seems to be not a good situation right now. Let's put it that way.
Alrighty. What else do you have, or is that it for today?
What was there? Yeah, I mean, there's the Tesla thing and the Carvana thing we did recently. Shorted both of those back in the game, and then I just wanted to talk about the first brands in the car. Yeah, that's all I got. That's all I got for
All
today.
I have to run, so you're going to have to discuss your healthcare home runs without me, David. So,
all right.
great.
Well, we're going to talk about.
All right, buddy.
Update next week. Have a good weekend, guys.
See you.
But David, I'm
I
looking at the map, right? The map right now, it's it's the only green area in the market right now.
Healthcare, baby.
Yeah, baby.
So a couple of things. So first, I wanted to talk about HIMSS because something happened. So the 2 points here. First, we have somebody out there who keeps saying that live by the short, die by the short, when the stock was really volatile, and he was like wrong at 15 and then wrong at 20. And he and I do really respect him, but he was wrong on this one. But then when HIMSS hit 60, I've tormented him. I've sent him direct messages of like, hey, bro, it's $60. Where's the 15? It's overvalued at 15. And he's like, you're like clockwork. You always remind me at $60. But I wanted to revisit it for two things. First, on a positive, which is, look, the stock's hanging in there, which to me is kind of surprising. It's been a lot less volatile lately than it was previously. And and sometimes you see these stocks settle down much lower. They don't settle near their highs. And so just to be clear, at 15, it was a long. Now at 58, I'm hardly involved. So that's good news that is hanging in there. The negative news is that I didn't want it to go. Now this is a little bit old news, but I didn't want people who listen who didn't catch up on this. But this guy joined HIMSS. Nader Kabani came from, I think, Amazon, and he was brought in May. Sorry, global operation infrastructure. He did the acquisition of PillPack, Amazon Pharmacy, and he is kind of heralded as this is going to be great. Oddly, he now says that like a week ago, he's going to step into an advisory role. He's no longer going to be the COO, and he's going to be an advisor. Now, in my experience, one of two things happens when something like that happens. When you hire someone huge profile, either it's a bad cultural fit, or something personal, health-wise, family-wise, has come up, and he said, "Look, I don't want to quit. I don't want to leave you in a lurch here, but I can't do this." So neither of those are great. And if it's the latter, I really feel bad for him, because we all have stuff like that goes on. But either way, for a HIMSS shareholder, you look at it and you say, well, something's happened. You said he was going to be COO. You said this was going to be great for you. Now he's an advisor. Advisors can never have the impact that a full-time person has. So going into this quarter, I'm a lot more cautious than I was before. I was cautious on the last quarter, saying it was the most important quarter for them, and they announced a whole bunch of launches or new categories. I think that actually executing on this is going to be a little bit tougher, but who knows? I may be completely wrong, and they may be way more profitable. So it's structurally a great company for the long run for redeveloping healthcare as consumer focused rather than insurance company focused. That said, they're still trying to do hard things, and hard things don't come easy. So just a heads up on HIMSS. Separately, Novo announced a deal today, and I originally thought, oh, this is a great acquisition. This is a company I own. It's a Chinese company that's working in obesity and elsewhere, or sorry, in oncology and elsewhere, Akiso, and instead they actually acquired Akiro. So my joy of, hey, a company I own is getting acquired by Novo at a giant premium is now like, oh, that's not. It's a non-deal for Novo. I mentioned that with the new CEO, he's going to start to do acquisitions like crazy to build out a pipeline and say, look, I'm changing the company. With acquisitions of development stage things, you generally look at higher expenses. So not a surprise. I don't think the market's going to really care about it. But just a heads up on that one. And you're right, Ben. Ben, healthcare has been doing, and we've talked about it for the last couple of weeks, been doing a lot better now that Pfizer did the deal, getting rid of tariffs, and there's a pathway for other drug companies to do the same. So, full steam ahead on healthcare, I guess.
Yeah, I mean, you nailed that. That was like a good like insight that you gave the chat. And I bought the XL. Like again, we talked about it. Like I think there is a general. If you're a generalist, healthcare is a tricky sector relative to other sectors. You just specialist knowledge is kind of needed almost. But I bought in early August and it started trading well. But like I look at today, and with the exception of Nvidia and Oracle, uh, Staples and XLV are doing well. So the healthcare is doing well, and defenses are just really cheap relative to the rest of the market right now, just like they were in the year 2000. Last time it was like this. So, come and check us out. And David's got all the good healthcare ideas.
Yeah. Well, I'll leave you with Halion. Remember, on a tough tape, you want some Tums. So chewable Tums, the greatest invention of all time.
Yes.
But Halion, HLN, I still own it. It's kind of round tripped a little bit. Not really. It's still up about 18% since I first recommended it, but it's still it's come way down. And as a defensive name in a bull market, that's what's expected. But I think it's a great company. So with that, let's call it. It's today's the 9th. It's 10:40, so we've gone a little bit over. Everybody find us at wallstreetbeats.com and passes.com/wallstreetbeats, and we'll see you next time.